Hello guys, welcome back to my channel. In this video we're going to discuss how the SEBI's new peak margin rules are going to impact the intraday traders. Okay, I'm going to discuss mainly about futures and options and not the stocks or shares that are delivered basically. Okay, that's in your holding. It's going to impact that as well. I'm going to do a separate video for that, but for now I'm going to stick with the impact on intraday traders trading futures and options. Okay, as you can see here in this box here, if you see, SEBI has made a new rules basically for how to increase the margins in a phased manner. Phase 1 was from December to February, when it started to collect 25%, which is like, what is a 25% is basically, for example, if one lot of Nifty is worth, let's say, 10 lakh rupees, and out of that 15% was the one that's normally collected for carrying forward position, which would be 1,50,000. That's for positional, like you can carry forward if you have 1.5 lakhs in your account, and you can carry it forward for the next day, or for how many days you want. Okay, now for intraday, brokers were used to give leverage or margins on that 1.5 lakhs as well, which was like 10x 20x. You have heard of all those things. For example, what 25% rule here from December to February meant is basically, for intraday trading you have to collect at least 25% margin that is required for carrying forward. So for 1.5 lakhs, 25% would be around 37,500. So you just have to have 37,500 to trade one lot of Nifty for intraday. Okay, and from March till May it went up to 50%. That is like 75,000, right? So you were supposed to have 75,000 in your account to trade one lot of Nifty. And in phase 3, which kicks in on June 1st, you should have 75% of that carrying forward positions. Well, whatever the margin is required, you should have 75% of that. So that would take to somewhere around 1,10,000 or something like that. And now from September 1st is the final phase. You should have 100%, that is 1.5 lakhs to trade in one lot of Nifty. So you are seeing the difference here, right? Brokers were used to give like 10x margins. Even if you had like 15,000 20,000 in your account, you could have traded in Nifty for one lot. Okay, so just imagine now it has gone up by like I don't know, they have taken off all the intraday margins, you could say, so requiring you to have full 100% of the margins. Not 100% of the value of the Nifty, which is 10 lakhs, but 100% of the margin required for you to carry forward to the next day. So what they're doing is, there is no difference in carrying forward and intraday margins requirement. Okay, it's one and the same. If you want to trade intraday, you have to have 1.5 lakhs. If you want to carry forward, you still have to have 1.5 lakhs. So there is no difference in margin requirement for intraday and positional trades. Now obviously, if you see this image here, it just shows you the statistics of how things have changed since these new rules have kicked in from December 2020. Okay, the MCX futures, okay, it has dropped by a massive 23% in volume, so it's really struggling basically, MCX, and the volume has just come down drastically. And for NSE, it's about 2% down. Okay, it's not much, but it is coming down, and mind you that this is just till April. Okay, so once the full margin requirement kicks in, it's going to come down as well. And in the same time, if you see here in options, okay, in MCX as well, the options trading have gone up, the turnover has gone up, and in NSE it has gone up by massive 67%. So you are now thinking like people are moving to options. So this clearly shows that there were plenty of small time traders, okay, who wanted to uh, have leverages margins in trading, and especially in intraday trading. It's actually, so we're going to discuss in few kind of we're going to segregate these traders. Okay, how we are going to do that is, the first one, let's look at how it is going to impact the seasoned traders or professional traders who trade every day and who have been trading for many years. So basically they are seasoned in this market, and they have been trading for a quite long time, and they know very well about the market, how it's going to impact them, and how it's going to impact the novice traders, and how is it good or bad in overall. If you look at it, is good or bad. Let's look at in more detail about that. So let's look at the seasoned traders perspective. Obviously they were enjoying the lots of margins or leverages they used to get all these years. Okay, some were offering like 20x margins. I mean, it's unbelievable how brokers were offering these kind of margins to these traders. I mean, they were not differentiating between a seasoned trader or a novice trader. It was just for everybody to use. Okay, so from these seasoned traders perspective, it's going to be a huge impact on them, because the volume is going to come down heavily now. With just 1.5 lakh, let's assume, if a person had like 1.5 lakhs in his account, he was very free to trade in, like, say 10 lots or 8 to 10 lots, right? So now it has come down to just one lot. So the person will have to have more in his account, in her account, to trade 10 lots, right? So to trade 10 lots now, the requirement has gone up to 15 lakhs. I mean, considering the 10 lakhs, if Nifty is worth 10 lakhs. So you can see the impact there. Okay, so they have to shell out a lot, and that's going to be a big problem for traders. Okay, so they had money, they were enjoying these leverages, and they knew very well what they were doing. They knew what the risk was, and they were managing really well with a very less money requirement, but trading big. But now they have to have more money to trade big. So what it does is they have to have more money to trade less. That's the kind of situation. So it's going to be a problem for them. It's a bad thing for them. Now, from the novice traders perspective, let's go there. Obviously the same thing. They will have to have 1.5 lakhs to trade in one lot. Okay, so I mean, they would have had just 30-40,000 in their account and still trade one lot. But now I mean, because they are novice traders, they really don't want to trade in huge lots. So it's kind of okay for them to have like 1.5 lakhs maybe, and then trade in just one lot, because they just have to shell out a little bit more, assuming that these novice traders just trade in one lot and not more than that. So they used to have like 30-40,000 in their account. Now they have to put in like another lakh or so. Okay, so it's going to have an impact on them too, but it's not going to be in a big way as with the seasoned traders who used to trade in multiple lots. Okay, so the bottom line is, those who are trading with multiple lots is going to impact them a lot, because they have to shell out a lot of money, and they have plenty of money in their trading account. For the novice traders, it's going to impact them, but it's not going to make a huge difference for them. I mean, if they somehow manage to fund their trading account by another lakh or so, they should be all set to go. So it's not going to have too much impact on them. Now the question is, okay, so we have seen that it's bad for seasoned traders. It's kind of little bit bad for the novice traders. Now, is it good or bad overall for the economy, for the market, and everything? Let's look into that. It's not a bad thing to provide margins, because we have seen like 500x margins in forex. And you know why they provide so much of not in the MCX forex I'm talking about, in general, like wherein you can trade multiple global currencies, you can get like 500x 700x margins and all those things. The reason for that is that market is completely developed, it's fully mature, it's got huge liquidity, and uh, you know it's basically it's a well structured and fully matured market forex is. So that's why they provide that much of leverages and all those things. Okay, and so now our market is kind of, it is, the penetration rate is still very very less. And especially after this pandemic, you might have seen like many people are interested in this stock market, and then many people have started putting their money in the mutual funds and all those. So somehow there is this euphoria that they want to get into the market. Okay, so that even the government is seeing that, the SEBI is seeing that, and even we are also witnessing that there is a euphoria of in the people basically to get into the market, so which is a good thing. So the penetration rate will automatically increase. So there will be some domestic investors and traders, which is good for the market. At the same time, it's the responsibility of the uh, monitoring authority here, which is SEBI, to ensure that the investors' money is kind of safeguarded. Okay, so if somebody loses money, it's not like they have to protect them from losing their money because they are taking wrong trades. It's not that. They have to protect from the outside basically, so that they provide a platform that is safe to use and that encourages more people to come in, and at the same time ensure that they're going to bust their accounts frequently. Okay, so and you have seen that many people just come in and then go. They just lose all their capital, right? So that's what the SEBI is kind of looking into now. If you look at it, there is already a margin being provided for a 10 lakh worth of shares. You are just paying 1.5 lakhs, right? Just 15% of 15, or for stocks it is 20%. Okay, so you're just paying 15 to 20% of the overall thing. You're already taking the margins, so it really doesn't make sense to take extra margins and on top of the margin provided and trade. That just tempts you to trade multiple lots, and that means huge risk. It may be good for a seasoned trader, but for the novice traders who are now like entering the market in a huge rush, obviously market doesn't want to, the SEBI doesn't want to put them in a spot where they are going to lose all their money without having proper knowledge, right? So they don't want that, so they are restricting here so that they know, they understand the risks involved, and even if they lose, they are not going to lose big. Okay, that they cannot afford. Of course it's up to the individual traders and investors to protect their money, but there should be a platform that is conducive for novice traders as well, and have proper guidelines and safety measures in place. So from that perspective, this is what's going to happen. And also you could see that because people could trade in multiple lots with less amount, there was too much of speculation. Okay, so the price just sometimes been very volatile, sometimes just goes up and then comes down crashing down and then suddenly goes up. So this kind of volatility is going to disappear from the market once this kicks in. Okay, it's good in a way for novice traders as well as for the seasoned traders, because you don't want that kind of you know uh, simple, I mean, there is no reason behind for the price to go up and come down. You don't want that kind of swings, whipsaws, because it's going to hit your stop losses and then you make you lose money, right? We have seen that plenty of times, and we don't want that. Actually, we want some market to move in a certain direction with some logic behind that, not just crash or not just go up. And that was happening a lot in stocks as well as in index, and that kind of unnecessary or unwanted volatility will go with these new rules in place. And especially those who are experienced as well, it's, I would say, it's kind of blessing in disguise for them as well, because if they, obviously if they are seasoned, they know how to read the market, how to read the charts, and how to invest in all those things. Now they can expect a smooth kind of movement in the market prices. Okay, it's not going to be highly volatile, it's going to move in a uh, regulated manner, I would say, which is good for them because their stop losses will be protected from unnecessary whipsaws. It's good for novice traders as well. It's good for the economy, because for Indian, the market like Indian economy and Indian markets, we need more and more domestic investors, traders, everybody. So that's how the market matures and develops. and during this stage you have to have proper rules. So I'm definitely in favor of this new margin requirements. As I said, you're already being given like 85% margins. Okay, you're just paying 15 to 20% of what is required, and I don't think you should expect more than that. And you have had your time, and many people have busted their accounts due to these margins itself. So it's very bad. As I said, those who know how to manage the risk, it's good for them. But because new people are entering, and the economy needs more and more investors and traders to come into this market, this is a fantastic move. This is at the right time. And more people, and then if they have money, they will regulate their risks as well. It's a fantastic. So overall, I would say it's a very good idea in the long run. Okay, in the short term you might see some volume drop downs as you're seeing here, and more people would move into options trading because it requires less amount of money. But again, one has to understand that option trading involves again huge risk, because if you don't know how options premium work, then you are not going to make money out of it. To briefly tell you, let me say this. See, if you are buying, right, it has to move, the price has to move very quickly so that you can make profits. Okay, now those who are selling, either the market has to move in their favor or just go sideways. So out of three things, the market can do three things, right? One, it can go up, or it can come down, or it can go sideways. So those who are selling, they make money if they go in their, if the market goes in their direction, or even if it stays in the sideways, they will make money. But for an option buyer, they only make money when the price goes in their favor. If it goes sideways, they're not going to money. If it goes against, they're going to lose money as well. So if you look at that, there is only 33% of probability that you are going to make money in options buying, and 66% of chances when you sell. Okay, so that's the equation. That is just very briefly I have touched that. It's just, there are many things that you have to understand when trading in options. But yeah, this is what is happening at the moment. And by this, SEBI is ensuring that those novice traders, they're not going to bust their accounts too frequently, and not too many accounts will be busted. So it's kind of putting a fence to their risks. That's all. Okay, and overall, I'll conclude that this is a fantastic idea, and it should have been in place much earlier. But yeah, better late than never. It's a fantastic one, so embrace it. And initially you might find it hard to deal with this, but in the long run you are going to appreciate what they have done. Okay, I hope you like this video, and please share with your friends if you like it, and also subscribe to my channel if you haven't, and also click on the notification bell so that you get notified whenever I upload new videos. Also check my other videos which are really educational, and that's going to help you in your trading. And join my free Telegram channel where you can get some live updates on some live trades that I take, and all those things, my trading ideas. Thank you guys, see you soon.